not many calories in this particular statement. I think the important word, if there is going to be an important word in a headline tomorrow, would be symmetric, in which the Fed basically signaled that yes, inflation is at 2%, but maybe if it goes to 210 or 220, it's a symmetrical movement around 2%. But I don't think it's significant, and I think the Fed ultimately is on the move, probably in June, and maybe one or twice thereafter. But I would expect for the balance of the year in 2018 for maybe a average 30 or 40 basis point hike and not much move in terms of the 10-year.
So right now, they stayed at 1.5 to 1.75. And we were talking just a moment ago that their mantra seems to be first do no harm. At what point does that short-term rate, the Fed funds rate, start to maybe do a little harm? Is there a threshold in your mind, a river not to cross?
Well, that's the question of the, I guess perhaps of the decade, ever since Lehman, and probably for the next few years too, one in which the Fed is grappling with. And I think, yes, a higher short-term rate certainly is reflected in Fed funds, but also in LIBOR, in three-month LIBOR, which is really the private market and where individuals have trillions of floating rate debt, connected to LIBOR. I think, since LIBOR now at about 235, and it was 1.25. In other words, rates have doubled for many borrowers over the past 6 to 12 months, that yes, if short-term rates go up by another 25 or 50 basis points, that I think real growth and some disruption in terms of borrowing on the part of individuals is going to take place.
Bill, it's Sarah. Is the Fed right not to be too overly concerned with rising inflation? You hear more and more chatter these days about the potential for a Fed mistake. You've got rising tariffs on steel and aluminum, the prospect of more tariffs, and a potential trade war with China, a rising dollar. In other words, could inflation get a little more overheated, and then would the Fed be behind the curve?
Yeah, I think there's possibilities, Sarah. You mentioned several points in terms of tariffs. I think the stronger dollar ultimately is not inflationary. It's basically the other way. And real growth, as we've seen in the first quarter at 2.2%, probably moves higher at 2.5 or 3% for the balance of the year. So all of those, in combination with tight unemployment, basically suggest that inflation could move higher on a core basis. But the symmetric term today in the Fed statement basically tells me that if it's 2.1 or 2.2, they won't be that concerned. And face it, Sarah, for the rest of the world, for the globe itself, in terms of Japan, in terms of Europe, and in terms of the United Kingdom, et cetera, there's very little inflation to be seen.
So have we seen the peak on global growth?
I think so. I think we've seen it certainly in terms of the EU, perhaps not in terms of Japan, but it's very low there to begin with. In the United States, 2.2, we've got our program. We've got a $1 trillion deficit ahead of us over the next 12 to 18 months, I suppose, and that's certainly very stimulative. It may produce growth of 2.5 to 3%, but basically on a global basis, I think the rest of the world has peaked.
If I want to put money to work in fixed income, it seems pretty obvious to me that there's very little advantage to going long. I mean, if the 2-year note is at 2.5 and the 5-year note is at 2.8 something, and the 10-year is at 2.9 something, why would you ever risk the longer duration?
Yeah, that's a great point, Tyler. You pointed out the flat yield curve. And yes, when the yield curve gets flat, there's very little incentive to go long. Why not? Because a 10-year Treasury and a 30-year Treasury basically are much more volatile than a 2-year Treasury or even short-term cash, which isn't volatile at all. So, there's very little incentive to go out long in the bond market. We've seen for the first 4 or 5 months that bonds are down about 2.5% on average for the year. And yeah, I would characterize it as a hibernating bear market, one in which, the bear is sort of growling but waking up, but not really, the grizzly that we know, during noontime. So there's very little incentive to go there. I would go in other directions.
So if you don't think the 10-year yield is going to move very much for the rest of the year, Bill, where do you see the opportunity? Are you buying the U.S. dollar?
Well, you know, I see there's opportunity, strangely enough, and this isn't a convertible bond type of idea, but it's an arbitrage type of idea. There's a number of situations. Investors know of them, I suppose, in terms of arbitrage and buyout situations. Time Warner, for one, to my way of thinking, offers investors a 5, 10, 15% return if that decision goes the right way. Monsanto is a arbitrage situation over the next few months where you can get a 5 to 10% type of return. And Aetna Health is a situation that offers even more. So, you know, I'd go convertible equity in terms of these situations to earn a higher rate of return with a little bit more risk, obviously.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.